When Peter Lynch turns 10, his father dies from cancer.
It was a real tragedy because at the time, Lynch's father made a lot of money as an accountant that provided a very good lifestyle. Lynch's mother didn't have to work.
But now she has to go back to the workforce, taking on 2 jobs at once. And in order to support his mother, the young Peter Lynch has to grow up quickly and to start working as well.
Peter Lynch is near the top of anyone's list of great investors.
He consistently trounced the market for over a decade by observing great ideas in the world around him, then researching them, and then buying them if they could stand the test of time.
In the 13 years he ran the Fidelity Magellan Fund, he racked up annual average returns of 29.2%.
With his father gone, Peter Lynch's mother is determined to make enough money in order for Lynch to stay in the private school. She knows that is the best way to guarantee her son's future. But to make it easier for her, the 11-year-old Lynch is desperate to find a job of his own.
He never expected to work at 11 years old. He wanted to have a normal childhood. But Lynch was a very understanding boy. Seeing how hard his mother worked to provide for him, he made up his mind from an early age that he was going to make so much money when he grew up that his mother would never have to work again.
But the type of jobs for 11-year-old is limited. He ends up becoming a caddy at a local golf club. His first job as a caddy allows Lynch to appreciate the hard work and learn social skills. But more importantly, it is there he meets his mentor that will completely change his life forever. To help support her mother, Peter Lynch becomes the hardest working caddy on the golf course. There, he meets the executive vice president of Fidelity, George Sullivan.
Peter Lynch stood up from the crowd because of his work ethic. But what really left an impression on George Sullivan was that one time Sullivan misplaced his umbrella, and Lynch used his own money, as little as it was, to buy a new umbrella to give it to Sullivan. And that act of kindness by Peter Lynch really left an impression on Sullivan. Peter Lynch's excellent work on the golf course pays off. And with Sullivan's recommendation, Lynch gets accepted to Boston College and receives full scholarship from a caddy scholarship fund. In college, Peter Lynch finds out that the most helpful subject to learn about stocks is not economics or mathematics, but philosophy, especially logic.
I was on the liberal arts side of Boston College, avoiding all the required math and accounting courses, the normal preparations for business. Instead, I studied metaphysics, logic, and philosophy, along with history, psychology, and political science.
They're called humanities because they're all about people. And finance, to Peter Lynch, is all about people.
At Boston College, Lynch scores perfectly in tests. But he knows the true way to examine his knowledge is not by passing his exams, but by investing in the real world. Founded in 1945, Flying Tigers was the first cargo airline in the United States. In 1961, it became one of the first carriers in the world to offer aerial pallet shipping service. Before then, aerial commercial shipping was expensive and nearly non-existent for larger goods.
Flying Tigers would be considered a growth stocks because it was a new and small company. But Lynch saw that the whole aerial shipping industry was going to explode, and Flying Tigers was going to be the leader of it.
With strong conviction, Peter Lynch put majority of savings in Flying Tiger's stock. But for the next 3 years, the stock becomes stagnated. It never goes beyond the original price of $7 Lynch bought it at. If Peter Lynch learns anything from his career on the golf course, it is that it takes patience to win. But Lynch has no idea what is about to happen.
The United States is therefore prepared to take all necessary steps, including the use of armed forces, to assist any member of the Southeast Asia Collective Treaty in defense of freedom.
The Vietnam War unexpectedly becomes the best thing that's ever happened to Flying Tigers.
Initially, Lynch thought that Flying Tiger's business would grow as a result of tapping into the commercial shipping business. But the Vietnam War happened so unexpectedly, and it sent the stock price to the sky.
By 1965, Peter Lynch's original $1,250 investment becomes more than $6,000, more than enough to pay for his grad school at Wharton. While pursuing his MBA, Lynch continues to disregard economics and finance classes that are out of touch with reality. He devotes all of his free time researching the next stock to buy. And after graduation from Wharton, he's eager to get into the real world. But fate intervenes. By the time Peter Lynch graduates from Wharton, the Vietnam War has reached the critical stage. It turns from a special military operation to a full-blown invasion. The US now needs to recruit more soldiers to send to the battlefield. Peter Lynch is one of them. But fortunately for Lynch, he's stationed far from the battleground, all the way in South Korea. And he spends a large part of his time researching his next investment idea. It won't be easy, as he is far away from any companies in the US. But he believes he could replicate his success with Flying Tigers. He just needs to find another small growth company that no one on Wall Street knows about. A 10-bagger.
A 10-bagger is a stock in which you've made 10 times your money. I suspect this technical term has been borrowed from baseball, which goes up to a 4-bagger or a home run. In my business, a 4-bagger is nice, but a 10-bagger is a whole lot better.
And with persistent effort, Peter Lynch finds a perfect stock to buy. Sugar beets and sugar canes are the main plants used to produce sugar. But unlike sugar canes, sugar beets can grow better in a cooler environment, such as the state of Maine. The Maine Sugar Industries is a refiner of sugar beets. In 1965, the company finds a genius solution for increasing production. It realizes that since there's a very little overlap between the harvest time of potatoes and sugar beets, it will be profitable to convince the potato farmers to grow sugar beets as well. Lynch understands clearly that this is a 10-bagger situation, mostly because no Wall Street firms have yet taken notice. He immediately buys as many shares as he can by calling his brokers from South Korea, expecting to have a windfall once he goes back to America.
Farmers in general tend to be very risk-averse, and the Maine Sugar Company couldn't convince the farmers to plant sugar beets in full capacity. Instead, most of them only use less than 1/4 of their farms.
After coming home from Korea, Lynch vows to never make the same mistake in the future. He will never buy stock again without research and, more importantly, on-site investigation.
If you're working hard, you're always checking with competitors, you're checking with customers, suppliers. You're trying to do work to find out, is this company still early? Do they have years and years of growth ahead of them? Then you stay with it, no matter, the stock goes down.
But in the meantime, he needs to make a living. In 1969, through his connection with George Sullivan, he becomes a research analyst at Fidelity, then the largest asset management company in America. By the 1930s, the mutual funds are mostly small family operations, consisting of firms made up of wealthy people. The only way to grow is through performance and word of mouth. But one Boston businessman, Edward Johnson, thinks there's a better way.
Ed Johnson was a great salesman, so he thought to himself, why not treat mutual fund like a product? So he was one of the first to hire professional salespeople who barely knew anything about finance to distribute their mutual fund to the public.
On top of that, Ed Johnson shifts the focus of the mutual funds from speculative gambles to a safe place for people to earn stable returns by using the new concept at the time called diversification. By 1962, Fidelity becomes the biggest mutual fund company in America. But with success comes competition.
So what happened from the 40s to the 60s was that a lot of mutual funds became overly obsessed with raising money rather than focusing on making returns for their investors. So a lot of these funds spend so much money on salespeople, on brokers, rather than on investment research.
To beat the competition, Ed Johnson starts deploying a diverse set of strategies, including a fund focused on technical analysis, run by pioneer Jerry Tsai. With his unique way of analyzing charts and patterns, Jerry Tsai's fund outperforms the competition by a wide margin. He becomes a star in the mutual fund industry. His success takes Fidelity to a new height.
At the time, technical analysis was relatively new. Tsai was using mathematics to spot short-term patterns that other people haven't quite caught up yet, and that's why it worked for him.
By the late 1960s, the bull market is slowing, but with Jerry Tsai's performance, Fidelity is thriving. As Ed Johnson gets close to his retirement age, Jerry Tsai becomes an apparent successor. But surprisingly, Ed Johnson decides that Fidelity is always going to be a family business, and his son Ned Johnson becomes a new boss at Fidelity. After Tsai left, Fidelity loses a great number of clients.
In the investing world, clients' loyalty always lies where the profit is. In this case, they follow where Jerry Tsai goes.
Worse yet, by 1969, Fidelity is found guilty for its involvement in an insider trading scandal when their broker conspired with a client to commit a fraud. With profits down and with the loss of clients, Ned Johnson struggles to find a solution. He understands that to turn Fidelity around, he needs to find someone just as talented as Tsai. And it turns out the solution has been standing right in front of him this entire time. America is at a turning point. After the Great Depression and World War II, it became the most powerful nation on the planet. It's a testimony to the efficacy and the resilience of the capitalist economic system. But where there's a free market, there's always a cycle of boom and bust. By the early 1970s, the economic recession has arrived. Peter Lynch had a rough childhood, but through hard work and ingenuity, he graduated from the top business school in the US. And by learning stock picking from hands-on experience, Lynch excels at Fidelity as a research analyst. While the stock market collapses, Peter Lynch's stock recommendations thrive. However, after the exit of stock trader Jerry Tsai, Fidelity is struggling to grow. It lost 1/3 of its assets in 1 year alone. The new CEO, Ned Johnson, aimed to find a brilliant trader just like Jerry Tsai. But little does he know, the man who will eventually take Fidelity to the moon is anything but like Jerry Tsai. The Magellan Fund was initially set up by Ed Johnson and George Sullivan as a boot camp to train future fund managers for Fidelity. Lynch started in 1969 as a steel and metals analyst.
Lynch was a research analyst, but on the side he was building his own little stock portfolio that consistently beat the market. So all the employees at Fidelity always came to him for stock tips.
By 1974, it becomes apparent to Ned Johnson, Peter Lynch is the kind of talent he's been searching for. He promotes Lynch as the new head of the Magellan Fund, which at the time was a closed fund, consisting mostly the wealth of Johnson family and their executives. As the new boss of the Magellan Fund, Lynch knows, to outperform the market, he must do things the rest of the market doesn't do. As the bear market rages on, most mutual funds shift away from stock investing. But to Lynch, a bear market only means one thing: bargains.
There were bargains everywhere in those days. My portfolio continued to grow. Pretty soon, I became known as the Will Rogers of equities, a man who never saw a stock he didn't like.
As a savvy poker player, Lynch believes that with a portfolio full of potential 10 backers, the law of probability will inevitably be on his side.
If I find 10 good stories, they're all equally attractive, I buy all 10, and I wait to see them unfold. It's like watching 10 poker games, 10 games of stud poker. You watch the cards turn over, story 3 gets better, story 6 slips, story 7 stays the same, but it goes up 50%, so you sell 7 and buy 2.
And his first 10-bagger is a very unlikely company. Taco Bell was founded by a white man called Glenn Bell, who was addicted to the hard-shelled tacos at his local Mexican restaurant. Bell learned the recipe and opened up his own stand in 1951. Before long, he made enough money to open a physical restaurant. And then 2 years later, a chain of Taco Bell restaurants start popping up in California.
On a trip to California, I was impressed with the Taco Bell burrito.
They had no debt, they never had a restaurant close, and I started buying at 7, and it was the largest position in Magellan in 1978.
Taco Bell may have been a treasure, but Peter Lynch is not the only one who's found it. In just less than a year since Peter Lynch invested in Taco Bell, the company is acquired by PepsiCo at $50 a share. Having an influx of reliable information was key for Lynch to gain an edge with the Magellan Fund.
We used to wait for the mail to come to see what Nike's inventories were like. You know, I mean you find out, we get in our library, in the first-class mail. So all this information, so the investing for the average person now is much clearer. They know the same thing as I do.
I want to thank the Daily Upside for sponsoring this video. It's a free business and investing newsletter that over 400,000 people subscribe to, including myself.
In an age where modern business news prioritizes disingenuous headlines and clickbait scare tactics, the Daily Upside is a breath of fresh air for the thoughtful investor. It was originally founded by a team of scholars, journalists, and investment bankers with the sole purpose of making you a more well-rounded investor. Every weekday they deliver a morning brief, followed by more detailed stories that are shaping the business world. It contains the breakdowns of current economic and corporate events in a clear and unbiased way.
I'm a big believer in creating impactful content. And as a reader of the Daily Upside, I think they're doing exactly that. I sometimes find interesting ideas and stocks that weren't even on my radar before. Then I will explore further on my own and often led to a stock trade or more insights. And I hope it will help you do the same.
Click the link in the description and join me to read the Daily Upside every morning. And if you don't like it, you can always unsubscribe the newsletter. By 1978, the raging inflation has left Federal Reserve very little options. The Dow Jones falls 18% by 1977. It's the same year Peter Lynch becomes one of the youngest money managers on Wall Street. While the rest of the market is down sharply, Lynch's fund has generated a 20% profit.
To Peter Lynch, stock picking is like an art form or a sport. The way he practices this art form is by immersing himself in the business that he's going to buy.
My stock picking method, which involved elements of art and science, plus legwork, hasn't changed in 20 years. Professional investors are missing the point. A pile of software isn't worth a damn if you haven't done your basic homework on the companies. They're scrambling to buy services like Bridge, Shark, Bloomberg, First Call, MarketWatch, when they ought to be spending more time at the mall.
In philosophy is called empiricism, which prioritizes learning from direct experiences over anything else. Peter Lynch forms his investment thesis by immersing himself in the business, rather than by just reading the numbers on paper.
It's essentially a human-driven approach, meaning that if Lynch likes the product and other people love the product and the management are good people, these serve as a better evidence than just figures on papers.
Lynch becomes unstoppable. A year later, while the market has bounced back to 18%, Lynch's Magellan fund has done even better, creating a 51% return in 1979.
We are Americans. God bless you and thank you.
As Ronald Reagan becomes the president, the age of prosperity has returned. The bull market propels Peter Lynch Magellan to stardom as it consistently makes mind-boggling profits. Although Lynch doesn't always pick the right stocks, he knows if he gets 3 out of 5 stocks right, in the long run, he will do just fine. But even with that assurance, one stock investment still catches him off guard. Founded in 1983, J. Belkner was an instant success. It became a popular specialty food store due to its understanding of the local consumers in Boston.
Bildner's is a specialty food store located across the street from my Boston office. It sells gourmet sandwiches and prepared hot foods. Bildner's is a cross between a convenience store and a 3-star restaurant. I had first-hand information that they had the best bread and the best sandwiches in Boston.
The store was perfect for middle-class white collars who had a little bit of a disposable income and who want something better than just microwave sandwiches for lunch.
When the company goes public in 1986, Lynch is the first in line to buy stocks at $13 a share. Since he's become addicted to their sandwiches, Lynch is confident that soon the stores will pop up across America and millions of middle-class Americans will enjoy their sandwiches as he does.
What Peter Lynch didn't realize was that Belkner was successful because it was local. It hasn't yet proven itself that it could succeed elsewhere.
And when Belkner opens a new store in Manhattan, it fails to compete with the infamous New York delis. By the time the company tries to open new locations in Atlanta, it has already run out of cash.
I'm sure the company learned from these mistakes, but there was no second chance once the money ran out. I gradually unloaded my shares at losses ranging from 50 to 95%. The lesson here is if the prototype is in Texas, hold off buying until the company shows it can make money in Illinois. Does the idea work in some other place? That's the question I forgot to ask Bildner's.
After learning his lesson, Lynch continues to hunt for 10 baggers. Companies whose products he enjoys, who have the ability to scale, and who somehow also have been neglected by Wall Street. But Lynch gradually finds out that as his fund grows bigger and he becomes more famous, it gets more difficult to find 10 backers. By 1989, the Magellan has become the most popular mutual fund in America, with $17 billion under management. Peter Lynch has been beating the market every year, making him the most celebrated investor on Wall Street. To Ned Johnson, hiring Lynch has been a stroke of genius. And to millions of Americans, Fidelity is Lynch, and Lynch is Fidelity.
Lynch is no question an ethical, hardworking, intelligent person. And that was exactly the brand image Ned Johnson wanted people to associate with Fidelity.
But then at the peak of Peter Lynch's career, he does the unthinkable. In 1991, after 11 years of exceptional performance, Peter Lynch resigns. For years, he was driven by the desire to provide for his mother and his family. He has pushed himself to work hard like no one else, even at the expense of spending time with his children. Peter Lynch knows what it's like to not have his father around.
Peter Lynch, manager of the nation's largest and most profitable mutual stock fund for 13 years, left his job at Fidelity's Magellan Fund in 1990. Lynch's decision to retire young was influenced by his father's death at 46, when Peter was only 10.
At the age of 48, Lynch decides that no amount of money can buy back time with his family. But there is one more reason why Lynch quit Fidelity.
What many people don't know was that Magellan was a closed internal fund for the first 5 years of its history. It had less than $1 billion in 1980, which was considered small even at that time. And when a fund is small, you have a wider range of companies to pick from. And if you look at Magellan's historical performance, the best years were in the early years. By early 1990s, as the size of the fund grows, and as a celebrity, it becomes increasingly difficult to find 10 baggers. Lynch decides that while Magellan is still performing well, it is time to retire and cement his legendary status as the most profitable mutual fund manager in history. But little does he know that even after retirement, a ghost from the past will come back and haunt him. By early 2000, mutual funds and other ETFs have become the most powerful forces in corporate finance. As a massive trillion-dollar investment company, Fidelity is often the biggest shareholder in many major corporations in America. So they literally have enough votes in their hands to change the fate of many US companies. What happens now is that whether if you're activist hedge funds or if you're an executive of a company, you need to be on good terms with guys like Larry Fink and the Johnson's family.
In 2008, the SEC charges Fidelity for receiving bribery from various companies amount to millions of dollars, including VIP tickets for Super Bowl, concerts, and even for strip clubs. And Peter Lynch is charged with a $20,000 fine for receiving bribery tickets for Broadway shows and for golf tournaments. But that setback doesn't affect Peter Lynch's reputation, as people trust that Lynch didn't break the law on purpose. In 2022, Peter Lynch is just as popular as ever. They come to find out that Lynch's way of investing is just as relevant today. Even though the success of Magellan Fund has made Lynch a rich man, he has made even more money for the Johnson family. Unlike other financial institutions, Fidelity is still a private company with almost $8 trillion of assets under management. And it is still tightly controlled by the Johnson family, who now is arguably one of the most powerful families in America. Thanks again to Daily Upside for sponsoring this video. Check the link in the description.